Hey class, hello guys. എൻ്റെ വോയിസ് കേൾക്കാൻ പറ്റുന്നുണ്ടോ? Am I audible? There seems to be a small latency issue. Alright, perfect. Perfect. Hi. Hi Gia. Long time. Sorry. ഒരു വേർഡ് ഫയൽ കാണുന്നുണ്ടെങ്കിൽ പറയോ? വേർഡ് ഫയൽ. റൈറ്റ്, ഒരു വേർഡ് ഫയൽ കാണാൻ പറ്റുന്നുണ്ടോ? കുറച്ച് നേരം കൂടെ വെയിറ്റ് ചെയ്യാം. ഫ്യൂ മോർ പീപ്പിൾ ജോയിൻ. നമുക്ക് അതിൽ സ്റ്റാർട്ട് ചെയ്യാം കേട്ടോ. വെയിറ്റ് ഫോർ ലൈക്ക് 2 minutes. സോറി, ഒരു ചെറിയ ഇഷ്യൂ. റൈറ്റ്, perfect. Yeah, we'll start shortly. Okay, കുറച്ച് പേരും കൂടെ ജോയിൻ ചെയ്തോട്ടെ. Start here. Shall we start? Right, so first time doing YouTube live appo adu karanam there might be certain issues, there might be certain hiccups. Wait, there seems to be some sort of trouble. What's happening? Connection cut avunnando. Are you facing any sort of trouble with the connection? It's fine, right? Yeah, showing it's fine. Yes, if at all you guys are facing any sort of trouble, do send me a message. Right. Yes, above, as we all know, we have 5 heads of income tax, direct tax പഠിക്കാനായിട്ട് നമുക്ക്. And it's into these 5 heads ഒരു assessed income, whatever, let it be anything, and classify ചെയ്യുന്നത്. And I put out a post ഏത് ഹെഡിനെ വെച്ച് സ്റ്റാർട്ട് ചെയ്യണമെന്ന്, and I got maximum votes for PGBP. അങ്ങനെയാണ് ഞാൻ PGBP ഡിസൈഡ് ചെയ്തത്. ദാറ്റ്സ് ഹൗ ഐ ഡിസൈഡഡ് വിൽ ഗോ ഫോർവേഡ് വിത്ത് PGBP എന്ന്. യാ റൈറ്റ്. ഇപ്പോൾ ഈ PGBP എന്നുള്ള ചാപ്റ്ററിനെ വി ക്യാൻ ആക്ച്വലി ഡിവൈഡ് ഇൻ ടു 4 പാർട്സ്. ആ 4 പാർട്സാണ് ഇപ്പോൾ നിങ്ങൾ ഈ സ്ക്രീനിൽ കാണുന്ന ഡയഗ്രാം. ലൈക്ക് ദിസ് ഇസ് ദ കംപ്ലീറ്റ് ബ്രേക്കപ്പ് ഓഫ് ആ ചാപ്റ്റർ. ഫസ്റ്റ് പാർട്ട് is the part of chargeability, the part that tells you about what makes an income taxable as a PGBP income. Now, what all conditions are to be satisfied, what all things have to be checked while charging a particular income as PGBP income, right? That falls under sections 28, 41 and 176. Predominantly 28 ലാണ് ഏറ്റവും കൂടുതൽ വരുന്നത്. 28 ആണ് അതിൻ്റെ കോർ ഏരിയ. ഒരു 99% 28 വരുന്നത്. ഒരു 0.9% comes at 41. 41 is for deemed income. അതായത് 28 talks about kinds of income which in general common understanding PGBPയിൽ വരേണ്ടതായിട്ട് നമുക്ക് ക്ലാസിഫൈ ചെയ്യാൻ പറ്റും. 41ൽ we have around 5 items. ഈ ഐറ്റംസ് ഡയറക്ട്ലി സ്ട്രെയിറ്റ് അവേ നമുക്ക് ചിലപ്പോൾ PGBP ആണെന്ന് ഐഡൻറ്റിഫൈ ചെയ്യാൻ പറ്റില്ല എന്ന് വരും. ബട്ട് ദേ ആർ ടു ബി ഡീംഡ്. ഇൻകം ടാക്സ് ആക്ട് പറയുന്നത് യു ഹാവ് ടു ഡീം ദം, യു ഹാവ് ടു കൺസിഡർ ദം ആസ് PGBP ഇൻകം. ഓൾറൈറ്റ്, യാ ഫോളോ ചെയ്യാൻ പറ്റുന്നില്ല ഞാൻ പറയുന്നത്. റൈറ്റ്, യു ഗൈസ് ക്യാൻ ഫോളോ, റൈറ്റ്? നൗ ഇതിൻ്റെ ഇടയിൽ 28 കഴിഞ്ഞിട്ട് ഞാനിവിടെ ഇട്ടിരിക്കുന്ന സെക്ഷൻ 30 എന്നല്ലേ. ഈ 28നും 30യുടെ ഇടയിൽ ഐ ഫോഗോട്ട് ഒരു കാര്യം പറയാൻ പറ്റുമോ? 176 സെക്ഷൻ 176. ആ സെക്ഷൻ എന്താ പറയണതെന്ന് വെച്ച് കഴിഞ്ഞാൽ ഇറ്റ് ഇസ് എ പെർട്ടിക്കുലർ സെക്ഷൻ വിച്ച് ടെൽസ് ഇസ് അബൌട്ട് എ സ്പെസിഫിക് ക്ലോസ്. നിങ്ങളിതിനു മുമ്പ് പഠിച്ചിട്ടുണ്ട്. നമ്മുടെ ഫസ്റ്റ് ചാപ്റ്ററിൽ, ഇൻട്രഡക്ഷൻ ചാപ്റ്ററിൽ പഠിക്കുന്ന റൈറ്റ് അത് ഇൻകംസ് ഓഫ് പ്രീവിയസ് ഇയർ ടു ബി ടാക്സ്ഡ് ഇൻ പ്രീവിയസ് ഇയർ ഇറ്റ് സെൽഫ് എന്നുള്ളത്. സി നോർമൽ രീതി എന്താണ്? വാട്ട് ഇസ് ഇൻ കോമൺ പ്രൊസീജിയർ? പ്രീവിയസ് ഇയറിൽ ഇൻകം ഓൺ ചെയ്യണു, അസസ്മെൻറ്റ് ഇയറിൽ നമ്മൾ ടാക്സ് പേ ചെയ്യണം അല്ലേ. 176 എന്നുള്ള സെക്ഷനിൽ പറയണത് എന്താ വെച്ച് കഴിഞ്ഞാൽ എ പെർട്ടിക്കുലർ കൈൻഡ് ഓഫ് ബിസിനസ് ഇൻകം വിച്ച് ഇസ് ടു ബി ടാക്സ്ഡ് ഇൻ പ്രീവിയസ് ഇയർ ഇറ്റ് സെൽഫ്. അപ്പോൾ ഇങ്ങനെ കാണുമ്പോൾ നിങ്ങൾ ഇത്രയും നാളിപ്പോൾ പഠിച്ചിട്ടുണ്ടാവില്ല 28, 41 ആൻഡ് 176 ഇതെല്ലാം കൂടെ PGBPയുടെ ചാർജബിലിറ്റിയിൽ വരും. ഞാനാകെ 28 മാത്രമേ പഠിച്ചിട്ടുള്ളൂ എന്നായിരിക്കും എല്ലാവരുടെയും ഒരു ഐഡിയ. അപ്പോൾ ഈ 41 ഒരുവിധം ടാക്സ് ഇതിനു മുമ്പ് പഠിച്ച അല്ലെങ്കിൽ ഒരു എക്സാമിന് വേണ്ടി പ്രിപ്പയർ ചെയ്തവർക്ക് 41 അറിയായിരിക്കും. പക്ഷേ 176 എന്നുള്ള നമ്പർ ചിലപ്പോൾ ന്യൂ ആയിരിക്കും. ദാറ്റ്സ് ബിക്കോസ് ഈ 176 എന്നുള്ള നമ്പർ നമ്മൾ ഫസ്റ്റ് ചാപ്റ്ററിലാണ് പഠിക്കുന്നത്. ഇറ്റ് ടോക്സ് അബൌട്ട് പ്രോഫിറ്റ്സ് ഫ്രം ഡിസ്കണ്ടിന്യൂഡ് ബിസിനസ്. ഇപ്പോൾ ഒരു ബിസിനസ് ഇല്ല, ഡിസ്കണ്ടിന്യൂ ആയി, പക്ഷേ അതിൽ നിന്നുള്ള നമുക്ക് ഇൻകം ഇൻ ഫ്യൂച്ചർ കിട്ടുകയാണെങ്കിൽ ഹൗ ടു ടാക്സ് ഇറ്റ്. അപ്പോൾ അഗൈൻ ദാറ്റ് ഇസ് ടു ബി ടാക്സ്ഡ് ആസ് PGBP ഇൻകം. ഇപ്പോൾ SSC ഒരു ബിസിനസ് ഉണ്ടായിരുന്നു, ക്ലോസ്ഡ് ഇറ്റ് ഡൗൺ. കുറച്ച് നാൾ കഴിഞ്ഞിട്ട് അതിൽ നിന്ന് കിട്ടാനുണ്ടായിരുന്ന എന്തെങ്കിലും റിക്കവറിയോ എന്തെങ്കിലും ഇൻകം കിട്ടി. അപ്പോൾ ദാറ്റ് ഷുഡ് ബി ടാക്സ്ഡ് ആസ് PGBP ഇൻകം ഇറ്റ് സെൽഫ്. പക്ഷേ 28ലും 41ലും അല്ല എൻ്റെ ചാർജബിലിറ്റി വേണം, 176ലാണ്. ഓൾറൈറ്റ്, ബേസിക് ഐഡിയ ഓഫ് 28, 41 ആൻഡ് 176 ക്ലിയർ ആണെന്ന് പ്രതീക്ഷിക്കുന്നു. റൈറ്റ്, യാ. ഇത് കഴിഞ്ഞിട്ട് സെക്കൻഡ് പാർട്ട് ഓഫ് എ സ്റ്റഡി ആൻഡ് തേർഡ് പാർട്ട് ഓഫ് എ സ്റ്റഡി എന്ന് പറയുന്നത് ഈ 28ൽ പറയുന്ന ഇൻകംസിനെ എങ്ങനെ കാൽക്കുലേറ്റ് ചെയ്യണം എന്നുള്ളതാണ്. സെക്ഷൻ 28ൽ പറയുന്ന ഇൻകംസിനെ എങ്ങനെ കാൽക്കുലേറ്റ് ചെയ്യണം എന്നുള്ളതാണ് 30 to 37 and 40 to 43B, which are the second and third parts of our studies. Okay, second part is sections 30 to 37. Part 3 is 40 to 43B. P 28 and 13 ഇടയിൽ സെക്ഷൻ ഉണ്ട് 29. What 29 tells is whatever the income be as per section 28, അതിൻ്റെ കമ്പ്യൂട്ടേഷൻ, അതിൻ്റെ കാൽക്കുലേഷൻ എല്ലാം ചെയ്യേണ്ടത് is as per what is mentioned from section 30 to 43B. The 30 to 43B contains a lot of sections which tells us a lot of things about how to calculate income under the head PGBP. But I have classified them as two, and those two classifications are 30 to 37 deductions allowed while computing your income under the head PGBP. 40 to 43B talks about disallowances. That is, what are the things that you are not allowed to deduct. See, what is the common procedure while you find the income of an entity or associated income? When you find the income of an associate, how do you find it? See, normal procedure is you take gross revenue. Say you are having a retail shop. Say you are conducting a textile business, textile retail business. How do you calculate the income of your entity for a month? You take your gross revenue, right? From your gross revenue, you deduct all the expenses that you have incurred, right? And the difference between your revenue and your expenses give you what? It gives you your income, your profit, right? So the procedure is, you have a revenue, you deduct a lot of items, yeah, you get profit. Simple. Now what Income Tax Act says is, say when you prepare your P&L, your financials, you follow whatever is applicable to your company as per accounting standards, right? Fine, we have nothing against that. We have nothing to say or to oppose to what you do with your accounting standard preparation. But then, when you are preparing your records for income tax purposes, you cannot take deductions for all the expenses on the basis of how you take them while preparing your financials. Well, let me just open a note. I'll show you how it works. Right. You guys can see a note, right? A note is visible, right? Sorry. Right. See, we have our profit and loss account. Just assume this to be a basic profit and loss account. Yeah. You have your gross revenue here, fine, and all the expenses here, a list of items. Now the balance depending on which side is higher determines whether you have profit or loss. So I'm assuming a case of profit. So gross revenue, the total appears here, and the total we take it to this side, and the balance we treat it as profit. Correct? Yeah. So this is the common procedure that we follow while we prepare our financials. Now, what Income Tax Act says is, say this is your profit as of financials, this is your income, right? This represents your income as per your financials, but then this is not the income, this is not the income, this is not the income which the Income Tax Department accepts. What Income Tax Department says is, we require you to do some calculations or adjustments to this profit, and based on the adjustments that you make, you will reach to another income which shall be treated as taxable income under the head PGBP. Fine. I'm hoping you all have studied cash flow system, cash flow preparation. Yeah. We have two methods in cash flow preparation, right? One is direct method and the other is indirect method. Just like that, for calculating PGBP income, we have two methods. One is similar, both are similar to the direct and indirect methods of cash flow. I'll show you how. The indirect method starts from your net profit. Net profit as per P&L. Alright, so you take the net profit. Fine. Now to this you make a lot of adjustments based on sections 30 to 43B. Alright. So 30 to 37 tells you about the deductions that you can take. 40 to 43B tells you about all the disallowances. That is what all is not allowed, what all are not allowed to be deducted. Alright. So you take this net profit and you make adjustments for a couple of items. Item number 1. Out of this net profit, add back all disallowances, if any, was taken while computing this net profit. Say in your P&L there is a particular item of expense which has been booked, and as per Income Tax Act you are not supposed to deduct it while computing net profit. Add it back. Alright, fine. That is step number 1. Step number 2 is to deduct less all allowed deductions. All allowed deductions are to be deducted. So this is to be added back and this is to be deducted. Fine? Fine? Now you have a figure. You have an amount here, right? In case your profit and loss on its revenue side has an item of income which was not supposed to be considered under PGBP, take it out. Say for example, you have a business, right? I told you you are running a textile business. Say you have certain amount of money deposited in a bank. You are receiving interest for that bank deposit. So interest is an income that you're receiving and you record it in your financials in the profit and loss revenue side as interest received. But as per Income Tax Act, interest received, yes, it's an income, but it should not appear under the head PGBP. It should go to IFOS, right? So out of this figure, deduct again any income falling under another head. Take it out. Alright. This resulting figure shall be your PGBP income. Not necessarily, see, please do keep in mind what I just gave you is a basic bare blueprint. Now this is not a standard format that you can take and apply it every case study or every case scenario. I'm just giving you an idea of how it works, on how the indirect method works. Alright, this is the indirect method, and 99% of your questions or majority of the questions that you see for your examinations require you to compute PGBP income as per this method. That is to start from net profit that is given in the question. In the question, you'll be given a P&L account and you'll have net profit and you'll have to start from that net profit. All the adjustments and everything you have to pick out from the question and do adjustments as necessary. Alright. There is also another way. Wherein you start off with revenue from operations. You just take your operations revenue and don't bother about any disallowances because you haven't deducted anything here. You have taken your gross revenue. This is gross revenue. From that you deduct items as per section 30 to 37 while you pay close attention to 40 to 43B as well. You keep in mind 40 to 43B items and deduct items from section 30 to 37, and the result is PGBP income. Fine? Is that fine? Yeah? Right. Now I'm going back to our Word file. So yes, got the basic idea, right? And the final part number 4, that's a special section. You see, what you're going to study there is not something that is related to what you learn from part 1 to part 3. That is a completely different area. That's a special section where you learn about very special provisions with respect to 1, your books of accounts, on how to maintain them and how to get them audited, and 2, regarding a very unique methodology of taxation called presumptive taxation. Most probably we will not be dealing with that section in today's class because our class will be winding up by 9 and I do not think I'll be reaching the 4th part today. Alright, I'll do my best to cover part 2 and 3. In case you have any doubt, please do let me know. Do actively participate in the chat box and do let me know if at all you have any kind of doubt. Fine. So right. Also big props to my students who helped me in preparation of this book. I know some of you are listening to this live, you are attending this live. So yeah, section 28 talks about a lot of stuff. I have categorized them as general, compensation, Keyman Insurance Incentive and all. If at all you want this book, do let me know. Do give me a message if you want this material. I can make arrangements so that you can get this. So I'm skipping the first area, 28, 41 and 176. I'm skipping it for now. Heading straight to part 2. That's a place from where the real deal starts. Right. Part 2. Sections 30 to 37. Deductions allowed while computing PGBP income. So this flowchart that you see right in front of you is a very short, precise, concise summary of the whole area, of the whole part. It starts from section 30, ends at section 37, and every single section that you have to learn from 30 to 37, I have listed them out here. So if you want, you can take a screenshot right now. Yes. So out of all the things that you're seeing here, I will pick out 2 to 3 sections which are supposedly the most important area, the most important areas under this part. Number 1, 32 to 32 AD, depreciation, the second flow, right? Then 35, alright, that's very important. 35 is very important. 35 AD, under 35 miscellaneous, the first one, 35 AD, that's very important. 35D is very important. 35D is very, very important. 37 and 36, they are also equally important. 36 and 37. But then if I am to rank them, the topmost priority will fall for section 32 to 32 AD, depreciation. That is the most important area. Then comes section 35. Then comes 35 AD and 35D. Alright, so these are the the 4 most important areas you have. Without doubt, you will be required to have crystal clear understanding of all these 4 sections that I mentioned for any problem that you are to do for PGBP. Because based on the question papers, previous year question papers that I've analyzed, I found that these 4 sections, they come repeatedly in your question papers. Depreciation, scientific research, specified business, preliminary expenses. The rest of the sections, yeah, they are important, but they are not as commonly asked as these 4 sections that I just mentioned. Alright, yeah. So section 30 to 31, we'll start off with 30 to 31, sorry, 30 and 31. Revenue expenses, so 30 and 31 are regarding certain revenue expenses a company, a PGBP, a business or a profession running SSC incurs. 30 talks about revenue expenses with respect to building. 31 talks about revenue expenses with respect to plant and machinery and furniture. Right. So section 30. Expenses related to building used for business, revenue in nature only revenue. 4 kinds of expenses. Rent, maintenance or repair, property tax paid. Be careful when you see property tax paid, make sure that this particular property tax is paid for the business building, the building used for business. So I'll give you an example. Same case scenario, the textile business that you're running. You pay property tax for your building which you use for business. Alright, your textile showroom, you pay property tax for that building. Deduct, no problem. But at the same time, you have another property which you have let out. Alright, and you are receiving rental income for the same. You have taken this income and put it in your financials. Also, you are paying municipal taxes for this let out building. You are paying property tax for this let out building. And this will appear in your balance sheet, financials as well. And this might be grouped along with the property tax that you pay for your showroom building, for your business building. You are simply not allowed to deduct the tax paid for the building that you have let out, because for the building that you have let out, your income will not be taxable under PGBP. It will be taxable under house property. Right. So obviously, since the income is taxed under a different head, an expense relating to that income shall only be deductible under house property. It cannot be deducted under PGBP. Income, house property. So the related expense Take it to house property. You cannot deduct it while computing PGBP income. Clear? Fine. The chat box seems to be a bit inactive. Can you guys please participate? Yeah. Alright. Next. Section 31. Expenses related to plant, machinery and furniture. Plant and machinery and furniture. What all expenses can you think of that you would incur for plant and machinery and furniture? For sure, repairs and maintenance, right? You would require to repair, maintain, service your machinery, equipments, tools, whatever hardware that you're using to run the business, right? Second, plant and machinery. You will say you are buying a very expensive machinery to your building. It costs say 5 lakh rupees. It's something related to manufacturing of textiles, alright, yarning machine. Since it's a machine, expensive stuff, you'll definitely insure it, right? You'll definitely insure it, yeah? Insurance premium. That is a deductible item as well. Okay, I left out to mention insurance premium for building. It's mentioned here, the fourth item, insurance premium under section 30. Same insurance premium for plant and machinery and furniture as well. Now you might wonder, see, building and plant and machinery and furniture, both these have another common revenue expense, depreciation, yeah? But then depreciation is not deductible here. Yes, depreciation is a revenue nature expense. Yes, it is deductible, but not under 30 and 31. It is deductible under section 32. Alright. Now, there will be instances where you see SSEs, you come across SSEs wherein they hire machines, they hire equipment. They do not buy them. Instead, they hire them. They rent them out. Now, this is again a revenue nature expense that you incur for the purpose of running business, which should be deductible. Yes, it is deductible, but it will not be deductible section 31. It will be deductible under section 37. 37. I mentioned it here. Rent or hire charges paid for plant and machinery or furniture is available as deduction, but under section 37. Alright, so there is a possibility that you might come across a 1 mark question wherein they ask, rent paid for machinery hired is deductible under section dash. You might be given options like 30, 31, 37 or not deductible. Do remember, yes, this is a revenue expense you have incurred for machinery, but it is simply not deductible under section 31. Rather, it is deductible under section 37. Fine? Clear? Yeah? So, any doubts with section 30 and 31? Any doubt? If you have any doubt, please do comment in the chat box. Please do comment in the chat box. So since this is the first time I'm doing a YouTube live, I have absolutely no idea how to open the streaming studio section of YouTube in my PC. So I've opened the same in my mobile phone and I'm looking at the mobile screen. So you might notice me looking down at times. It's because I'm checking the chat box. So any doubt here? Or can I proceed? Clear? Right, super. Also, in case if I'm going too fast, do let me know that as well. Alright. Next, 32. Depreciation and investment allowance. You might not see this particular term investment allowance mentioned in a lot of books. It's just a term that I use for easier understanding of the concepts that you learn here. Okay. So this whole section of 32 can be divided again into 5 areas. Out of the 5 areas, the first 2 areas represent base depreciation. The rest of the 3 areas represent 2 other areas of depreciation. I'll explain. Section 32.1.1 and section 32.1.2, the first 2, they represent the base methodology of depreciation that can be opted by the SSE. 2 options are there for an SSE. 2 options. One is SLM and the other is WDV. See, generally every SSE has to follow WDV method of depreciation, that is written down value of depreciation, written down value method. I'm assuming you know what it means, yeah? SLM stands for straight line method. Now that's the second option given. But then SLM cannot be taken by every other SSE, every SSE. SLM option is only given for SSEs who are into the business of generating power. Power generating SSEs. They have the option to choose either SLM or WDV. Alright, they can choose either straight line method or WDV, and it's completely up to their choice. Alright, we have detailed notes on both of them coming, so I'm just closing the explanation for the base depreciation for now. Now after that, that's the first part I told you, right, base depreciation. Now after that, you have the additional depreciation and investment allowance. So if you look at this second flow chart, I mentioned base depreciation for power sector units, you have an option of SLM or WDV. For other SSEs, it's only WDV. For SSEs who have opted for WDV method of depreciation, if applicable, they can proceed to taking section 32(1)(2)(a) additional depreciation and investment allowance. So do remember, only for SSEs who have opted for WDV depreciation, they have an option, not an option, they are eligible of claiming an additional depreciation or enhanced depreciation or accelerated depreciation under section 32(1)(2)(a). Also along with that, they can claim an additional investment allowance if they have invested, if they have started, or if they are carrying out their business in certain areas termed as notified backward areas of 4 states. The states are Andhra, Telangana, Bihar and West Bengal. Alright, we'll be discussing all that in detail, yeah? And besides this, another kind of depreciation available to an SSE is section 32(2) unabsorbed depreciation. I will not be teaching about unabsorbed depreciation in this study. I'll be teaching about unabsorbed depreciation in the study for carry forward and set off. Alright. In simple language, unabsorbed depreciation refers to depreciation which could not be absorbed because of lack of profit. Say you have depreciation of 100 lakhs or 10 lakhs. You only have an income of 2 lakhs. That means out of the 2 lakhs income, you can only deduct 2 lakhs from the depreciation. The rest 8 lakhs remains as balance, which is not deducted. You carry forward this 8 lakhs to coming years and deduct it. So for the coming year, this 8 lakhs carry forward is depreciation not absorbed from previous year, from previous years, preceding previous years. Got it? Got the idea of unabsorbed depreciation, yeah? So base depreciation, understood, WDV and SLM. If applicable, if eligible for an SSE who follows WDV, the SSE can take additional depreciation and investment allowance. Fine? Fine? Oh, thank you so much for the lovely comment. Right. Now let's go to the 2 kinds of base depreciations. Sorry. Now before going to base depreciation, there are certain points, purely theoretical points that you need to know with respect to depreciation. Certain points that you need to know. I've mentioned them here. I'm not interested in explaining them throughout the study, so I would suggest you to take a screenshot of what you're seeing right now. So quickly take a screenshot of what you're seeing and we shall proceed. Or you can read this when you have time. Okay, after class you can read this. I'm not discussing about all these theory stuff because it will result in us losing precious time. Yeah? Right, perfect. Now, base depreciation. First one, SLM mode of depreciation. Now, the SSE eligible is only SSEs engaged in power sector. That is an SSE who is engaged in generating power or generating and distribution of power. So, generation is key. Point number 2, SLM is only available for tangible assets. Intangible assets, no. It is not available for intangible assets. Alright. Point number 3, each asset is treated individually. You know how straight line method depreciation works, right? Say you buy an asset for 10 lakh rupees. Say this asset has 5 years of life. 10 lakh divided by 5, 2 lakh per year is your straight line method depreciation. 2 lakh you deduct for 5 years and depreciate the complete value. That is straight line method. And here you treat each asset individually. Each asset is treated individually as on the date of purchasing them and putting to use. Alright. Now this is a choice which is given by Income Tax Act to power generation assessees. They can either choose this or go for WDV. Always remember. Alright. Always remember, this is a choice given for assessees who are engaged in power sector. Now, in case an assessee decides to transfer this particular asset. Say I am running power generation business and I have certain assets for which I have charged base depreciation. And I have charged base depreciation, sorry, not base depreciation, SLM depreciation for an asset which I am using for my power generation business. I'll go to same example. Asset value 10 lakhs. Life, 5 years. So what is your SLM depreciation per year? So depreciation per year on SLM basis is 10 divided by 5, 2 lakh per year. Correct? Yeah? Alright. So this purchase was made on, let it be 1819 previous year. Alright. So right now we are in previous year 2021. In year 2021, I sell this asset. I've sold it. I've sold it for say 8.5 lakhs. I've sold it for 8.5 lakhs. So what did I do here? I transferred an asset which I had purchased for my business. Right. Now this is a transfer happening. This is a capital asset being sold. Right. Generally, when we transfer a capital asset, what do? We treat it as a capital transaction, and complete income calculation with respect to this particular transfer will be dealt under the head capital gains. Right. But then, since this is an asset which was used by an assessee who claimed SLM depreciation for the same, you cannot simply take this as a capital transaction and treat it under capital gains. This particular transfer will have an implication on the assessee's PGBP income. I'll show you how. I'm giving you 3 scenarios. Okay. 1, I sold it for 8.5 lakhs. 2, I sold it for 3 lakhs. 3, I sold the asset for 12 lakhs. These are the 3 scenarios. Fine. I'll show you how the work or effect of balancing charge or terminal depreciation comes. What Income Tax Act says is, if the assessee transfers an asset for which SLM depreciation was charged, and if the value of transfer is more than the book value of the asset, then the assessee has balancing charge. So if transfer value more than book value, you have balancing charge. If the transfer value less than book value, you have terminal depreciation. Okay, and in the case where the transfer value is more than book value, there is a possibility that there will be capital gain as well. Let's check how. You'll understand from the explanation of these 3 scenarios. Fine. So 8.5 lakhs, 3 lakhs and 12 lakhs. So what was the value of the asset? 10 lakhs. And how many years did we use? We used it for 18, 19, 19, 20. Okay, let it be 17, 18. Let the purchase year be 17, 18. So we are using it for 3 years. So for 3 years, what is the depreciation? 3 into 2, 6 lakhs, right? We have depreciation of 2 lakhs per year, right? So our depreciation for 3 years will be 3 into 2, 6 lakhs, right? So what is the book value of our asset as on the year of transfer? It will be 10 lakhs minus 6 years depreciation, 6 lakhs. 4 lakhs is our book value. Fine, correct, following. Yeah, right. So our transfer value, 3 scenarios I've listed. Now I'm listing our book value, 4 lakhs in all categories, all areas, 4 lakhs. Fine. balance, the difference. Here transfer value is more than book value, right? There's a 4.5 lakh difference. This 4.5 lakh will be treated as balancing charge. Now this balancing charge will be treated as a deemed income under section 41. Deemed income under section 41. This is to be added while income is computed. Fine. Now here transfer value is less than book value. That is, we sold it for a loss. 1 lakh loss, right? This 1 lakh loss is called terminal depreciation. And this can be deducted while computing income under PGBP. Now here, the third scenario, you have sold it for 12 lakhs. Now if you check the value that you sold it for, that is the transfer value, is actually higher than your cost of acquisition. Your cost of acquisition was 10 lakhs. Correct? Cost of acquisition was 10 lakhs. Right? So this 12 lakhs minus 10 lakhs component, 12 lakhs minus indexed 10 lakhs, 12 lakhs minus 10 lakhs component, right? Yeah, 12 lakhs minus 10 lakhs component will go to capital gains. Alright, 2 lakh will go to capital gain. The balance of our, let me just rewrite this. 12 minus 4, you have 8 lakhs here, right? 8 lakhs here. Out of this 8 lakhs, the difference of transfer value and cost of acquisition, that is 2 lakhs, it will go to capital gain, and the balance of 6 lakh will be treated as balancing charge and treated as PGBP income. Fine. Sorry, you can't see that area. Alright, now is it visible? Yeah, I'm guessing you understood the concept of balancing charge and terminal depreciation. Yes? Any doubt here? Any doubt? No, right? Pretty simple. Yeah? So that's all that you have to know with respect to straight line method depreciation. Always remember, this is an option given by the Income Tax Act for power generation assessees alone. Alright? Oh, sorry. Yeah? Next, going to the second category of base depreciation, that is WDV. And this is the option given to every other assessees. Not an option, this is the only option given. Every other assessees who are in power generation can choose between WDV or SLM, but SLM only applicable for tangible assets, not intangible. Right, now WDV is method of depreciation wherein you take the value of an asset, apply a particular percentage as depreciation, deduct it, get the value at the end of year, use that value for the next year, apply the same percentage on that value, deduct an amount, bring down the amount year after year like that. Right, say 10 lakh asset was 10 lakhs. Your depreciation rate is 10%. So first year you deduct 10 lakh minus 10% of 10 lakhs, that is 1 lakh. So your remaining value is 9 lakhs. Understood? Then next year you take 9 lakhs as the base figure. From 9 lakhs you deduct 10% of 9 lakhs, that is 90,000. Your balance will be 8.1 lakhs. Next year you take 8.1 lakhs as the base amount. You deduct 10% of 8.1%, that is 81,000. Right? That's how WDV system works. Alright. So for WDV system, you do not categorize assets individually. Rather, you categorize assets into block of assets. Alright. Now how do you determine a block? A block means a group of assets which has the same class or same category and same rate of depreciation. So two things to be checked. One, the class or category of the asset, and two, inside that class or category, what is the rate applicable. So if you find assets which fall under the same class or category and also they have the same rate, then they will be treated as a single unit. They'll be treated as a single block. Say I have a machine worth 10 lakhs which has 10% depreciation, and I have another machine worth 25 lakhs which again has a 10% depreciation. Do keep in mind machinery does not have 10%. I'm just giving an example. Alright, so let it be 15%. 15% depreciation. So 10 lakh machinery with 15% depreciation, another machinery with worth 25 lakhs with 15% depreciation, another machinery worth 50 lakhs with 20% depreciation. So the class is same, all are machinery. Class is same, category is same, but only two out of the same class has the same rate of depreciation, the 10 lakhs and 25 lakhs one. So 10 and 25 I'll add and I treat it as a single block with a value of 35 lakhs. Understood? Is it clear? Yeah? Understood the concept of blocks? Perfect. Right. So the different classes or categories as per Income Tax Act are as follows. You can see that in the small table. Buildings, plant and machinery, furniture, intangible assets. These are the different categories as per Income Tax Act's classification. Alright. And under each of these classes there are different rates. Only for buildings and plant and machinery, not each of these classes, just for buildings and plant and machinery there are different rates. For buildings you have rates of 5, 10, 40. For plant and machinery 15, 20, 30, 40 and 45. Alright, so in total there are as many as 10 blocks of assets. 3 for buildings, 5 for plant and machinery, 1 for furniture and 1 for intangible assets. 10 blocks. 10 blocks. Now when you get a case study, when you see a case study scenario and you see a lot of fixed assets, you see a lot of items there, first categorize them based on the class. Building, bring all of them together. Plant and machinery, bring all of them together. Furniture, bring all of them together. Intangible assets, bring all of them together. Under building and plant and machinery, do a further classification based on the rate applicable. Alright, a detailed explanation of the class, that is a category, and rates is given in this following table. Alright, I'm not doing an in-depth explanation of this table. I would suggest you to take a quick screenshot of what you're seeing right now. Yeah, I'll quickly go through. So, sorry, this is not block, this is class or category. Class or category. Category, and inside that you have various assets. So, building category you have 3 kinds: residential building, other building, temporary erections. For residential 5%, for by other what I mean is office buildings, factory building, the general business building 10%, and temporary erections. By temporary erections what it means is, say if you have seen the metro construction happening in our state in Kerala right now, you would have noticed that when a construction is happening of a particular station, the metro company, the KMRL, the DMRC, they set up a temporary office to take care of all their dealings which happens at that particular construction site. It is a temporary office. They will take it off, they will remove, it's a makeshift setup, yeah. They'll take off that setup as and when the construction is complete. So that's a perfect example for temporary erections of buildings. Alright. Furniture 10%, just one rate. For plant and machinery, multiple items, everything is listed here. And under plant and machinery we can categorize further as a group for vehicles, a group for computer, IT and energy saving devices, and a group for books. Alright, so vehicles you have aeroplanes, ships, vehicles which were hiring business, normal vehicles put to use, purchase and put to use after 23/8/2019, that's a particular date classification given there. I'm not wasting much time, but then in case if you want me to explain this further, do let me know, I can explain it further. Alright, for now take a screenshot of the same. Right. Now that's how you come to a conclusion as to what is the block in which a particular asset falls. Now you charge this particular percentage on the WDV of the asset. Now how to calculate this WDV? How to find out the WDV of a block? Simple. If the asset is purchased and put to use in the current year, if the complete block is purchased and put to use in the current year, that is all the assets in a particular block was purchased and put to use in the current year, take the value of the asset. Nothing, just take the purchase value, just take the actual cost of the asset. That's it. But then if these assets, or if this block has assets which were purchased, some of them were purchased and put to use from preceding previous years, and at the same time there are assets which are purchased in this year as well, the computation will be a bit tricky. What you have to do is first take the opening WDV. Take the opening WDV of the block. You will be given this item will be given in the question. Along with that, add the cost of whatever addition that you have made. So say I have an opening WDV of 10 lakhs. I purchased assets worth 3 lakhs this year. So 10 lakhs plus 3 lakhs, 13 lakhs. 13 lakhs, that is just total A. Now, say I sold some assets from this block this year. I sold for say 8 lakhs. Deduct it. So from 13 lakhs, deduct 8 lakhs. That will be your WDV applicable for the depreciation for the relevant previous year. Say I sold assets worth 14 lakhs. 14 lakhs. So I had an opening WD of 10 lakhs, right? I purchased assets worth 3 lakhs. I had a total value of 13 lakhs. Now, out of the old machines that I had, I got a really good quotation for 3 machines. 3 machines out of the old machines that I had. A buyer agreed to purchase them for 14 lakhs. Now what happened here? My total was 13 and the sale value exceeded that 13 lakhs, right? Exceeded that 13 lakhs. Yes, there are machines remaining in my business even after the sale. But then, as far as income tax is concerned, this block will be non-existent from now on. Since you realized a value higher than the block value from this transfer, you shall not be allowed to take a benefit of depreciation any more from this particular block. Simple concept. Understood? Understood? Or do you want me to explain again? Do you want me to explain it again? Can you please come to the chat box, guys? Yeah. There is this very bad latency issue happening. I'm not sure why this is happening. The internet connection seems to be very stable, yet there is a latency issue happening. Yeah, so did you understand what I just said? Yeah? Clear? Everyone? I got response from Gia. What about the rest? Alright, perfect. So I'm proceeding. Alright? Perfect. So that's all that you need to know about the base depreciations available, WDV and SLM. Now moving forward, additional depreciation. Why is this happening? Additional depreciation and investment allowance. I'll quickly sum up this area. What Income Tax Act says here is, if the SSC is an eligible SSC, eligibility criteria number 1 is the SSC should have taken WDV, right? WDV as their depreciation, base depreciation method. And there are few other conditions as well. Now if an SSC is eligible and if the SSC purchases and puts to use an eligible plant and machinery, only plant and machinery, no buildings, no furniture, no intangible assets, only plant and machinery. And even in plant and machinery, certain things are not eligible. I've listed out what is eligible and what not is eligible in the note that you're seeing right now. So take a screenshot if you would like. So if an eligible SSC purchases and puts to use a plant and machinery which is eligible as well. Then for this particular plant and machinery, you can take an extra depreciation of 20% in the first year of putting to use. In the first year of putting to use. Clear? Fine? Simple case. Right? Now, add certain things to the section. Add certain things to the section. You get the investment allowance area as well. Eligible SSE. That is an SSE has followed WDV, but not just WDV. This SSE cannot be a power generation SSE. This is where a lot of students make a mistake. What happens is a student sees the case study, and in the case study or the question or the problem that you see for a question, it will be mentioned SSE who is into power generation has set up their entity in a notified backward area of Andhra, Telangana or wherever it is in the backward areas as mentioned. Now, this power generation SSE can take additional depreciation of 20%, but the thing is they cannot take the investment allowance. For investment allowance, what Income Tax Act says is, to be an eligible SSE, number one, you should have taken WDV, but then power generation, no. Power generation SSEs will not be eligible for investment allowance. Alright, rest of the things the same. New plant and machinery, eligible plant and machinery conditions the same. Everything that you have listed here is the same thing. If that's the case, then you can take an additional depreciation beyond the base depreciation, beyond the 20%, an extra 15%. An extra 15%. Now what you're seeing right here, this rule of 180 days, yeah, I've mentioned the same thing in the previous post that I showed. I showed you a pure theoretical post for depreciation, right? Important points. I've mentioned it there, and I'm assuming you have taken a screenshot of the same. Right. So depreciation, that's it. Base, WDV SLM, if applicable, additional depreciation and additional investment allowance. Clear for everyone? Yeah? Clear, yes? We will check two more sections today and wind up the video. Sections 33AB and 33ABA. Right? So shall I proceed to sections 33AB and 33ABA? Yeah? Please come to the chat box. Can I proceed? Perfect, right. 33AB and 33ABA is regarding a special account maintained by certain categories of SSEs. 33AB is for SSEs engaged in the business of tea, coffee or rubber growing and manufacturing. Tea, coffee or rubber growing and manufacturing. 33ABA is for SSEs who are engaged in the business of extraction of petroleum products, natural gas products. Alright. Now what Income Tax Act says is, I'll first explain about 33AB. An SSE who is engaged in the business of growing and manufacturing tea, coffee and rubber products. Tea, coffee and rubber products. If you are into this business, we will give you one benefit as per section 33AB and another benefit as per section 10. Section 10, exemption for agricultural income. If you want to learn about agricultural income, I have a video uploaded in YouTube for agricultural income, a single video where I've explained the complete concept as applicable for examination. You can check my playlist, video playlist, and you'll find it. Alright, I've explained section 10 completely there. Yeah, coming back. So one benefit is for the agricultural income that the SSE earns, because the SSE is in the business of growing tea, coffee, rubber, right? That is definitely an agricultural process. And also the SSE is in the business of manufacturing something out of the grown product, the grown agricultural product. So there is a business activity coming in as well. So out of the total income that the SSE earns, the SSE can take an exemption with regards to the agricultural activity that he or she or the entity engages in. Fine. So twofold benefits. One benefit, deduction under section 33AB. Second benefit, exemption for agricultural income. So first let's check what is this deduction benefit. What Income Tax Act says is, if the SSE maintains an account as per the approval that they get from their board. See, SSEs engaged in tea business have a tea board. SSEs engaged in coffee business they have a coffee board. SSEs engaged in rubber business have a rubber board. A huge consortium of people who are engaged in this business, they have formed a board with the permission, with all the certifications or approval of the central government. Yeah, there is a board, spices board, we have a lot of fisheries board, we have a lot of boards for different categories of SSEs. So for SSEs who are engaged in tea, coffee or rubber, if they start an account with NABARD with the approval of their board, or they start an account with any other place, not just NABARD, any other bank or any other financial institution, provided they have the approval of the board and the approval of the central government, and they deposit money into this particular account, then for the deposit that they make, they can claim a deduction. See, it's not the complete amount that is available as deduction, but based on the amount that they deposit, they can take a deduction. The deduction available shall be the minimum of the actual amount deposited or 40% of their PGBP income, 40% of their business income. Alright, fine. So if an SSE has, say, 10 lakhs as their income and they deposit 6 lakhs, their deduction shall be 6 lakhs or 40% of 10 lakhs. What is 40% of 10 lakhs? That is 4 lakhs. So 6 lakhs or 4 lakhs, whichever is lower, 4 lakhs is lower, 4 lakhs shall be allowed as a deduction. Alright? Alright? Now there is a time limit clause with respect to this particular deposit. Now it's not like the SSE makes a deposit as and when he likes and claims a deduction. No, that won't work. There is a time limit. What the Income Tax Act says is, if you want to claim a deduction for the deposit that you have made, make sure that you deposit before the earlier of 2 dates. Date number 1, 6 months from the end of the previous year. Date number 2, date of furnishing return, that is 139(1). Date as per section 139(1). So different SSEs, they have different dates for furnishing returns, right? So take the date as on when you are supposed to file the return. Also take the date which is 6 months from the end of the previous year, that is 30th November. Yeah? Sorry, not 30th November, 30th September. Right? 30th September or the date of furnishing return, whichever is earlier, you should have made the deposit within that earlier date. Alright? Fine? Yeah? So in the example that I mentioned, let it be a tea SSE, tea grower. His total income is 20 lakhs. Alright? He deposits 2.5 lakhs, let it be 2 lakhs, not 2.5 lakhs, 2 lakhs to the account. Alright? Now the deduction available under section 33AB will be the lower of 2 lakhs or 40% of 20 lakhs, right? 40% of 20 lakhs is 8 lakhs. So which is lower? 2 lakhs is lower, right? So you can deduct 2 lakhs, 8 lakhs will be your remaining income. Fine. Now from this 8 lakhs, you can take out a portion as agricultural, and this will be exempt from tax. The other portion will be treated as business income, and this shall be taxable. Alright, fine, that is the second benefit. So first benefit, deduction for deposit made. Second benefit, exemption for agricultural share. Share of agricultural income in your total income. Fine? Fine? Right? Now, what is this share? How to find this share? Simple. To find this share, the Income Tax Act they have specified 3 rules. Rule 7A, Rule 7B and Rule 8. These different rules are given for different categories of assessees. Rule 7A is for a rubber growing assessee, an assessee who is in the business of growing and manufacturing rubber. Out of the total income balance that you have, 65% of it, take it off as agricultural income. Don't pay tax for it. Balance 35%, treat it as business income, pay tax. If the assessee is into coffee business, see coffee, I'm not sure whether you have noticed or not, in general market and all, you can get 2 kinds of coffee. One as coffee beans and the other as coffee powder. Alright. Coffee beans and coffee powder, right? The number one, the first one that I mentioned, coffee bean, you get the coffee bean as roasted or normal coffee beans. Right? Say you are in the business of coffee manufacturing, coffee growing and coffee manufacturing. You grow coffee and sell coffee as coffee beans just grown and cured. Also, you sell coffee beans as grown, cured, roasted and grounded as ready-made filter coffee powder or ready-made instant coffee. Yeah? So you sell grown and cured coffee. Also, you sell grown, cured, roasted, grounded, dusted coffee. Fine. So obviously the second category of growing, curing, roasting and grounding has more business activity involved. The first part was this growing, agricultural activity, plug them, cure them, sell. Not much of business activity happening, not much manufacturing process happening there. Whereas the second part, growing, fine, agricultural. But besides that, cure them, roast them, ground them, dust them, pack them, sell them. Lot of business activity has come in, right? So based on that logic, if the assessee is into growing, curing, roasting and grounding, the share of business income will be higher. Alright, so keep that logic in mind. So if an assessee is just into growing and curing, 75% will be treated as agriculture, 25% as business. But if the assessee is into growing, curing, roasting and grounding, your business income share increases. It goes from 25 to 40, and whatever has increased in the business income side will fall in the agricultural income side. So the 75 agricultural income falls to 60%, whereas 25 business income rose to 40%, right? And finally 40, no such further classifications as grown, cured or roasted or anything of that sort. It's just 60-40. So in our example it was T, right? The agricultural exemption share is 60% of 8 lakhs. The business income taxable share is 40%. And 8 lakhs, 60% is 4.8 lakhs, which is exempt from tax. 8 lakhs, 40% is 3.2 lakhs, which is taxable. This is taxable PGBP income. This is exempt. Don't pay tax. This is agricultural income. And in our country, an assessee does not have to pay tax for agricultural income, right? There are further things involved, further things applicable for agricultural income regarding the taxability and all. You can check my video on agricultural income and you will get a better understanding. Fine? Clear? Yeah? Simple, right? Yeah. Yes, now let's go to the next section, that is 33ABA. Very similar. This is again just like 33AB, a section where the Income Tax Act has brought in a special class of assessees, and Income Tax Act tells them, if you maintain an account as per what the government tells you, as per what the ministry tells you, and if you deposit amount into this particular account, yeah, take a deduction for this deposit that you've made. Take a deduction based on the deposit that you've made. Alright. So here in the assessee is an assessee engaged in petroleum or CNG business here, to prospect them or to extract them or to produce them or do all of them. Prospect, extract and produce. Okay. So it's a process of like mining, oil mining. Yeah. You might have heard about this, like they go into deep waters, go to deep seas, create oil mines, oil wells, take out petroleum products. Yeah, you should be knowing, right? So if you are necessarily engaged in this particular business, this will be, see, I'll give you a basic background of how this business works, so it will be far more easier for you to understand why this section exists. See, when you are into oil mining, when you are into extracting petroleum products, see, it's a long process. It will take years and years to extract out petroleum products from an oil mine, yeah, oil well. Now once you do that, you would have left a huge major impact to the environment in that area. Now it is going to take a lot of time for the area to come back to its normal form, or it might not ever come back to its normal form ever. But then as a responsible person, you have to take the responsibility to take as much as steps to restore that place. See, you have dug out a lot of things, right? You have, quite frankly, obliterated that place, destroyed the environment of that place. For that, you will have to take certain steps to restore that area. Yeah. Now to restore that area, you will have to incur a huge amount, an extremely huge amount. Now what Income Tax Act says, create a fund, a special fund called Site Restoration Fund. Now throughout your year of functioning, throughout your year of operation, deposit every year an amount to this fund, such that at the end of your operations, by the time you decide to wind up your operations and leave this place, you can use the amount from this fund for the purpose of restoring that area. Alright, now that is a special account we are talking about here. Alright, now it's not just necessary that the SSE has to use this fund only for restoring the area. He can use that fund for various other purposes of the business as well. Alright, now the SSE does everything as mentioned here, deposits money every year. Yeah, yes, he can take deduction for the deposit made. The deduction shall be the lower of actual amount deposited or 20% of yearly profit. Actual amount deposited or 20% of yearly profit. Fine, simple, cool. Yes, yeah. Now there are certain other points that you need to know. That you need to know with regards to this section. I have summarized all those points here. I would suggest you to take a quick screenshot. Take a screenshot of this page. I would suggest you to read them. Read these points. Okay, that page was not completely in full. Okay, sorry. Right. Wouldn't this fit? No, this won't fit the complete page. Let me just reduce the size by a little. Yeah, perfect. Take a screenshot now. Right, better. Took. That is, here you are seeing a set of points or conditions which tells you about certain restrictions on how to use this particular fund, certain restrictions on how long you have to maintain this particular fund, or how to maintain the assets, or how to lock in. Yeah, and certain restrictions with respect to withdrawal of money from this fund. Yeah, so take a screenshot of the same. Yes, so major portion of this section is done. Section 30 to 37 is done. Now we go to section 35, and since it's already 9, I'm deciding to wind up today's session. We'll do this for all the coming days from today, say not all, say around 7 to 8 days. We'll do this live based on the response that I get from you guys. Alright, fine. So I'm hoping to finish off the complete area for PGBP, direct tax intermediate syllabus with this set of 8 days. If at all you have any kind of suggestions or any kind of inputs to give on what to do to make these sessions more effective and better, do share. Alright, so tomorrow we'll resume from where we are leaving right now, that is from section 35, scientific research. Do join. Alright. Alright, so yes, that's it, that's all for today. I'm going to wind up. See you tomorrow. I'm hoping you all got a really good understanding of what I mentioned, what I taught, and from the notes that you're seeing on screen, I'm hoping that it was pretty useful for all of you. Yes. So if at all you have any kind of doubt, or if at all you have any kind of suggestions to give, please do reach out. Please do reach out. Comment. Use the chat box. Comment, or you can message me 9961223137. I repeat, 9961223137. That is my phone number. You can reach me on WhatsApp, or you can write to me at my email ID, nishantteaches@gmail.com. NISHANTHEACHES@gmail.com. Fine. So yes, that's it for tonight. Take care and see you all tomorrow. Much love and good night. Bye.